Hello and welcome to Dunedin Income Growth, a distinctive strategy for income and capital growth, a 1 hour programme brought to you by Citywire and Aberdeen. Thank you for waiting. My name's Gavin Lumsden, I'm from Citywire. With me in the studio are Rebecca Maclean and Ben Ritchie. Very good to see you both. The UK stock market has enjoyed a good rally in the past year, which is encouraging, but today's papers are full of the risks a new Trump administration may bring. Fortunately, as the managers of the only UK equity income trust with a formal sustainability approach, our guests know a thing or two about creating a resilient portfolio. Okay, that's enough from me. Ben, are you ready to begin?
Absolutely, Gavin.
Good.
Very much looking forward to it. Well, thank you very much for having us here today. It's a great pleasure to be here with Rebecca and to have the opportunity to talk to you and the audience about our trust. And it's something which we're very proud of. We've been managing the trust together over the last 2 years. I've been involved with running it going back to sort of 2014. And I think one of the things that's different about Dunedin is it's really been built for the long term and taking into account our experiences of investing both in the UK market and investing for income over the longer term. And we're going to talk you through why we do some of the things we do and what we think the benefits are from doing that, hopefully over the next 20 minutes. So we've titled this a distinctive strategy for income and growth. And I think that's really important. We don't set out to be different for different's sake, right? There's no point to just say, hey, you know, we're the multicolored guys over here and everyone else is black and white. There's no point in that. But we're doing this because we think ultimately over the long term, it will allow us to deliver superior amounts of income, growth in income, and capital returns over the longer term. And that's really, really important. And our goal is really to think about doing that over the longer term, through the cycle, and ups and downs within markets as well. So I think that's really, really important. A couple of things to pick out here. What is it that we're looking to do? Well, it's that differentiated approach within the marketplace on sustainable income. And really we think about that in 2 ways. First of all, sustained cash flows from businesses that they can then pay out in dividends, sustained income that we can distribute from Digit. Those 2 things are very important. And we also then consider that with a holistic approach to sustainability in the traditional sense as well. So really incorporating what we think is a holistic sense of risk management. One of the things which we think is particularly interesting about Dunedin today is that it's currently trading at a 12% discount. And we think that is absolutely crazy, really, when you've got a portfolio of large cap liquid UK equities which you could sell tomorrow at NAV. So we think that's a very attractive opportunity for investors, and Rebecca will talk a little bit about why we think the trust is at that discount and why that may not be there forever. Some of the really important things I think I want to leave you with, the sort of highlights are we've maintained or grown our dividend every year for the last 42 years. Sadly, back in 2009, the board decided to just hold the dividend. Had we not done that, we'd be a mega dividend hero. As it is, I think we're just an aspiring dividend hero. But just to say we have a very strong long-term track record of dividend growth and sustainability. We've delivered 100% total return to our investors since we repositioned the strategy at the start of 2016. The dividend yield today is 4.9%, so more or less in line with the Bank of England base rate, and I would guess by the time we get past 12 o'clock today, it's going to be about 15 basis points ahead of that. But importantly, a 20% plus premium to the wider market and a premium to the sector as well. As I say, trading at that very attractive discount. We see 5 key aspects that mark Digit out, and I'm going to talk about 3 of them, and Rebecca's then going to talk about a couple of them, and then we'll give you our outlook on markets at the end and the prospects for the trust. The first thing that we think is really interesting is the heritage of Dunedin. It's got a fantastic story. Actually, there's a wonderful book you can get on the website, which is implausibly long, telling you all about the history of the trust. And it's well worth a read if you're interested in financial history. Again, it's a real differentiator for Digit. The other thing we're going to talk about then is that focus on total return. Why do we decide to take that approach? Give you some insight into things that happened in the past and how that's guided us and how we think about things in the future. And then we're going to talk about resilient income delivery. And I'm going to hand over to Rebecca. We'll touch on our active positioning, the differentiation that we have, and then the integrated sustainability approach. So if we take that first element, the heritage of Dunedin income growth. Founded in Dundee in 1873, it's the second oldest investment trust in the world, and perhaps if Robert Fleming had got there a little ahead of F&C, we could be the oldest, but we'll take the second oldest, and it is the oldest Scottish investment trust. Now, over that long period of time, its goal of ultimately generating income and distributing it to investors has remained the same. It started out in those days in the emerging market as it was then of the United States, investing in railroad bonds. But today, that commitment to focus on sustainable income, capital growth, and resilience in terms of the distribution to investors remains the same. And it's a strategy that served the trust through a couple of world wars, many recessions, ups and downs in equity markets over that time, and bond markets as well. And I think one very interesting connection is that actually Ian Fleming is the grandson of Robert Fleming. So Dunedin really is the 007 of investment trusts as well in terms of its history. So it's got a fascinating history that's well worth reading about as well. And we feel that's very important as the guardians, custodians, I guess, of the trust while it's under our stewardship, that we do the best for our shareholders in that period. And that's very important. If I go back to the idea of total return, what do we mean by that? That's about thinking about the dividends that we get today, but also the total return, the capital return that we can generate from investing in companies. We've got a couple of charts here, which you may well have seen before, but I think the point I'll draw from them is maybe subtly different. The first chart, if we look here on the left, is the dividend yield. It shows you how the total return to investors in different markets has been delivered over the last 40 years. And what you can see in the UK market is that the dividend part of the total return, and this is in real terms, you've got to add inflation on top of that, has almost entirely come from dividend distributions. Very small amount of growth that's come from that. If you look at some of the other markets, the US, France, Germany, Japan, Canada, actually there's been much more that's come from the growth element. It's roughly balanced 50-50, which to my mind kind of makes a little bit more sense. But the lesson that many people draw from this is that you've got to own high-yielding equities, because high-yielding equities give you the dividends. Dividends make up most of the total return, therefore that makes sense. But if you look to the chart on the right-hand side, what that shows you is that high yields rarely actually translate into high dividends. If you buy companies with high dividends, they're almost certain or very likely to cut their dividends. And so companies with 16% dividend yields actually turn out to really only have 6% realized yields. And you can see the gap between the dark blue line and the turquoise line, and it gets bigger as the yields go up. And I think that's really important, because we think that you need to balance both income today with growth in that income and the capital growth that companies can deliver. And the reason why we think that is not just an academic exercise. It goes back to our experience and the experience of the trust, and I would say the sector, going through the post-GFC period. So as an observer at that time, Dunedin, looking to fill in the gap that it had between its earnings and its dividend distribution following the financial crisis and all of the dividend cuts, really pushed into high-yielding stocks to basically generate the income that it needed. In the short term, that was a good decision. But in the longer term, that was a poor decision, because the trust just didn't have the capital growth to be able to keep up both with peers and with the wider market. In 2016, there was a strategic review, and the board took the decision at the time. I was appointed to lead that with, at the time, Louise Kernahan, to focus on a much more balanced approach. Yes, we want companies that generate income today, but we've got to have sustainable growth in income and capital if we're going to be able to deliver an attractive total return proposition over the longer term. And it's that focus that can help get you out of trouble, because the companies that can generate sustainable growth are doing that because they've got certain kinds of characteristics which mean they're going to be able to manage difficult market environments. And that's, I think, really paid off for the trust. We'll show you some of the stats on this later. When we came into 2020, that was an existential crisis in many ways. And a huge number of companies cut their dividends in the wider marketplace, partly for regulatory reasons, partly because they had to. And Dunedin's income at that time fell by a very modest amount. And I think that's very important relative to the marketplace. So judge perhaps people when they're in tough market conditions, when times are hard. That probably really shows you the underlying merits of the approach that they're taking. And that's what we think is really important to bear in mind. And we can show you, how has that played out for Dunedin over the longer term. If you look to the left-hand side, you can see actually, pretty consistent delivery over the longer term. The market has been quite volatile, but Digit has grown steadily over this time period and is outperformed by around 12% since we repositioned the strategy at the start of 2016. So that's something which we think is really important. And you can see that on the right-hand side, that actually Digit does best when markets are tough. In down markets, it outperforms markedly and lags a little bit in the good times. And again, that's something where we want to have that resilient and really underpinned approach to both capital performance and dividend distribution. One of the things that we hold as an important tenet in our consideration around companies is quality. And by that, we're thinking around the strength of balance sheets, the cash flow that companies can generate, the 10-year experience, incentives of their management, the strength of a business model, the growth potential, the industry that companies are operating in. We look, analyze, our team of analysts help us to do this and score each and every company on each of those different areas. And that's really important because that gives the underpins for companies to be able to invest and manage and deliver over the cycle. Strong balance sheets with good cash generation, with the right people running them in attractive industries, with good business models. Those are the things that ultimately underpin the businesses, that underpins the cash flow, and that underpins the dividend. But start with the business, that will deliver the dividend. Don't start with the high dividend and work backwards. That's really, really key. But also what's really important to us is that focus on sustainability. And that's a real differentiator for us, that we put our mark in the sand around that. We think these things are important. This isn't some sort of niche exercise. This is critical to understanding the real holistic sense of risks that companies face. Because when you look at the top 8 dividend payers in the FTSE 100, they might look very reassuring. We know all these companies, these logos, we see them on the high street, on the things we buy on the supermarket shelves. But actually 5 of these 8 companies have cut their dividends in the last 15 years. I think 3 of them have cut twice, and 1 has even managed to cut its dividends 3 times. So I think that give you some indication as to how safe the underlying dividends of these companies are. And I think one of the things that we would also point out is that the drivers of earnings for the wider market are very cyclical. 40% of the dividends in the FTSE are coming from banks, which is effectively driven by the direction of interest rates, mining, which are driven by commodity prices, and oil companies driven by oil and gas prices. Those things may go up, they may go down. But I think the ability of people to be able to forecast the direction of bond yields, interest rates, and commodities is relatively limited. And certainly Rebecca and I would claim to have limited capabilities in that area. And I would suggest that most people probably find that quite difficult. Over the last 2 or 3 years, it's been a pretty good time to invest in those type of areas. But will that be the right thing to do over the longer term? We're just not sure. So we prefer to invest in companies which we think have got access to more structural growth and can allow them to deliver better over the longer term. And that for us is really, really important. So it's that focus on companies which we think really can deliver sustainable dividends and don't just be seduced by those household names, because actually they're not as safe as you think they are. And underlying all of that is actually the dividend growth. So the top 8 companies in Digit have delivered 7.6% dividend growth over the last 5 years, and compared to just 4%. So that's quite a meaningful delta in terms of the delivery that's come through there. So it's that combination both on resilience but also growth that we really, really need. And then if we come back to that history of thinking about dividend distribution, there's a couple of things to think about here. So we talked a little bit about the resilience of the income that companies are able to generate, but it's also about Digit's ability to be able to distribute that as well. And those are the 2 sides that you always have to face in income investing. How are the companies doing that you're investing in? And then how is the structure in which you're invested going to be able to distribute those dividends? And that's what's so fantastic about the investment trust structure, because it gives us that flexibility. And if you're really, really lucky, then you have a structure that Digit has. So I talked earlier about that 42-year track record of dividend distribution, enabled by the fact that we're able to distribute revenue and potentially capital reserves that can allow us to smooth out that distribution through the ups and downs of cycles. And if you look at the chart below, you can just see that steady progression in the dividend. Compare that to the volatility of markets, compare that to the volatility of earnings, even compare that to the volatility of dividends within the trust itself. This allows a steady, consistent progression. And we were able to put the dividend up 5% last financial year and more or less cover that with the earnings which we generate. Digit is also lucky because it does have that strong, flexible balance sheet. Low gearing, around 10%, a simple structure. There's nothing complicated in terms of the balance sheet that Digit has. Our revenue reserves are 65% of our annual dividends, so that's a good underpin. But one of the things that really makes Digit step out is the fact that it's so old. It has substantial capital reserves because it's generated all of these capital gains over the long term. So we have around about 15 years worth of capital reserves. So our capacity to be able to maintain and grow our dividend, even in tough markets, is really, really, really rock solid. And with that, I'll pass to Rebecca.
Thank you, Ben. Great. So I was going to talk about the positioning of the trust to start with, and then we can move on to sustainability. So it is an active portfolio with concentrated positions in 36 holdings. And you can see from the active share, which is 77%, that's high. So active share means it's the proportion of the portfolio which is different from the underlying index. So if that was a low number, that would mean that the portfolio was very aligned to the index. And if it's a high number, it means that the portfolio is different and it diverges from the FTSE All-Share. So as I say, it's a high active share. And why is that? Why have we decided to take that approach? Well, a couple of reasons. So the first is that there's good empirical evidence which suggests that it's the manager's best ideas which are more likely to deliver returns. So we're looking to concentrate our conviction in those names. Also, the types of companies that we're looking for, there aren't that many out there. We're looking for quality companies with resilient income, sustainable companies. And so that's a pretty high bar. So, out of the opportunity set, we're really looking to take the most attractive investments into the trust. And we're not just doing it for the sake of it. We're doing it because we want to position the portfolio to have the capacity to outperform the index. So we're doing it in order to deliver that relative return. So in terms of how are we positioning and how do you get to be so different from the benchmark? I think there are three ways of doing that. You can either have a concentrated positions in your ideas, you could be overweight smaller companies in an index, but you could also invest outside of the index. And Dunedin actually uses all three of those strategies in order to take that differentiated positioning versus the index. So as I mentioned, 36 holdings, we're looking to target about a 2% active weight versus the index in those ideas, and we're leveraging the resources that we have across Aberdeen to be able to pick those ideas. The trust is overweight the UK mid-cap index, so it's about 30% of the NAV of the trust is in the FTSE 250 and small caps, and that's double that of the index. We think it's a really compelling part of the market, some great innovative, quality, resilient companies which have fared poorly. If you look over the last 3 years, a real sort of material derating. They're out of favour with investors. We've seen outflows from the mid-cap space. So I think this creates an exciting opportunity for us to be able to look to invest in that part of the market. And then finally, using the ability to invest overseas. So the trust can invest up to 25% of its NAV overseas. And currently we have 20% in European companies. And why do we do that? I mean, there are a number of benefits. So the first would be that it gives additional diversification, allows us to invest in market leaders in different businesses, different industries, which you wouldn't get exposure to if you were just investing in the UK. Companies like an Novo Nordisk or an ASML, a Mercedes-Benz. These are industries which we don't have many peers in the UK market. It also means that it can be helpful from an income perspective because many of these markets have got a strong culture of paying dividends, and so that can be helpful when we're looking for income. And then if we look historically, the overseas allocation has been positive contributor to alpha, so it has been supportive. So taking that all together, there's a broad opportunity set. We think there's about 1,000 companies that we could, in theory, invest in. But from that opportunity set, we're looking to build a portfolio that's concentrated in best ideas and positioned to deliver that outperformance versus the index. So I'm now going to go on to talk about two holdings in the trust, which you may not expect to see in an income portfolio. So we've got two examples here. GTT is a French listed company, and Softcat, which is a UK mid-cap. So what do these two companies have in common? Maybe that's a good way to start. They're both market leaders in their specialisms in their fields. They've both got outlook for growth, both very cash generative, and have got net cash balance sheets, so strong financials, which allow them to pay a dividend and actually then grow that dividend over the medium term. So GTT, as I say, French listed business, it designs and engineers membranes that are used in LNG carriers. They've seen very strong order growth over the last couple of years due to capacity expansion in LNG, and going forward have the potential also to take on orders for replacing some of those carriers. But what this means for the business is they've got great visibility because they've got a robust order book, which means that they can see where those revenues are going to be in the next couple of years. Some of the orders are not for delivery until 2027, for example. So that gives them very good visibility of the growth that is on the horizon for the business. It's a market leader. It has nearly 100% market share in what it does. So very strong pricing power. And the reason for this is that it's got a superior technology. So the key thing for this membrane technology is about the boil-off rates. So you have to store this LNG at very low rates. And their technology is able to do that more efficiently than competitors. So this sort of technology leadership, in addition to being sort of having high customer service and being a very, very reliable supplier to the big carrier owners, means that they've got a very strong moat, and there isn't much in terms of a cost saving which can be made if a customer decided to switch away from a lower cost alternative which may be inferior. So that's a very strong moat for the company going forward. So taking that together, it's a very cash generative business. It's got very good margins. It's able to pay 80% of its earnings out in a dividend, and then in addition continue to invest and innovate in its core products and also in adjacencies too. So we think that's in a very strong position. And if you take that together, the dividend yield at the moment is about just over 5%, 6% next year, and it's expected to grow high single digits. So if you take that, that's about a mid-teens total shareholder return. So very attractive place and very much meets all those qualities that we're looking for in an investment for the trust. And then Softcat is a great sort of UK technology reseller. So they sell to SMEs in the UK. They've got 10,000 customers. They're selling hardware, software services. The market that they're playing into is a growth market. I mean, companies now sort of increasingly, they can't be particularly discretionary and about their spend in tech. Companies need to continue to spend in order to maintain and upgrade their technology infrastructure. And then if you add on top of that the trend towards AI, the demands for data center compute power and data engineering, that just adds additional layers of support for growth for the industry. And whilst the company has faced some weakness in the last 18 months, where there's been more delayed decision-making for their customers, they've still managed to deliver double-digit gross profit growth. So that's on the back of 20 years of delivering double-digit gross profit growth. So really fantastic performance, which is partly the market, but it's also their competitive positioning. They're taking market share and they are now the leader. And why is that? Why are they taking share? They've got the broadest offering. They've got a very strong reputation with customers. And what's crucial to them is their culture and their people. We were speaking to the management team a couple of weeks ago, and they reiterated again, the culture is their number one priority. It's the thing which keeps them up at night, and maintaining that culture, making sure that they incentivize their workforce and that they're on board in terms of the strategy. So we see them as a very strong leader in terms of that human capital management. So large market, growing, fragmented. They've got about 5% market share. We think they'll continue to take market share. Net cash balance sheet, they've got about 2.5% yield. They just paid a special dividend, and we expect that dividend to grow in line with earnings, which will be high single digit. So again, a good income. It's sort of a below market income, but a good growth outlook for that business in the UK mid-cap space. So I've talked about the positioning of the trust versus the benchmark and how differentiated it is. I think it's also worth pointing out that the trust is differentiated in what is quite a busy UK income investment trust sector. So that I think one point would be that point of that conviction holdings. It's got one of the lowest stock holdings in the sector, so that active positioning. And again, it's to be different from the benchmark in order to drive relative returns, because we believe that will allow the trust to outperform. But I could talk you through this on this chart that's on the right-hand side of the slide. This comes from Morningstar. It shows the UK income investment trust sector. So each dot is a different company, and it's showing on the x-axis the style exposures of the trust, and then on the y-axis the market cap of the companies in the portfolios. And I think what you can see from here is that on average, the UK income sector is overweight value. And that's not surprising when you're looking for yield. But Dunedin income growth is differentiated. It is much more weighted towards quality growth. So what we think this means is that it could be quite a good complement to other holdings that you may have in UK income space. But what is so important is that you've got that exposure to quality income, but it's not at the expense of the overall dividend yield of the trust. So, as Ben says, the current dividend yield is 4.9%. It's ahead of the market. It's also ahead of the peer set, which has on average 4.1% dividend yield. So you're able to get the yield, but you're also able to get that differentiated style exposure. In terms of addressing sort of why the yield is ahead of the market, it's a number of factors. Sort of underlying portfolio is pretty much in line with the market, but you're getting some additional yield there from leverage, which is about 10% levered. We've got some additional option writing, which makes up about 10% of the income of the trust. And then the third factor is the discount that the shares are now trading at versus the NAV of the trust. So sort of the final point of differentiation is sustainability. So I'll just speak to that. So firstly, sort of why is this strategy in place? So the sustainable and responsible investment approach was introduced in 2021. And the reason is that we believe that considering sustainability helps us understand the quality of business. So it enhances that investment quality of the portfolio. So we're looking for companies which are leaders in terms of how they operate, but also companies whose products and services meet sustainability themes or address those themes. And then we're also looking for companies which have the potential to change over time. So the analysis is very much focused on financial materiality. It's about risk management. It's about those growth opportunities, maybe so those structural growth themes that are driven by regulation, for example, or the consumer environment. It could be about efficiency. It may also be about competitive advantage, as we've just talked about with Softcat. For them, culture, their workforce, their talent is their key competitive differentiator. So we're considering all those things as we think about the quality of the business. And then, the chart on the right-hand side is making the point that the regulatory environment which companies are facing is evolving, it's complex and it's intensifying. And then, we look all the way through the portfolio at examples of companies which are facing more stringent regulation. Whether it is the house building sector, which has got the future home standards is coming in, it requires new homes to have a carbon footprint which is 75% below that of 2021. So that requires these house builders to innovate, to really change the fabric of those buildings and also put in new technologies. We're in Taylor Wimpey in the trust, and so that is relevant for that company when we're thinking about their outlook. We've got a new government in place, which is very supportive of renewable energy, has got very ambitious targets to increase onshore wind, solar, offshore wind, and those are crucial when we're thinking about companies like SSE and National Grid and their pipeline for growth. And so we need to be considering these regulatory factors when we're considering the financial investment case for the businesses. So on top of the companies, asset owners are also facing regulation, and as Ben said, it has been not necessarily the part of the market which has seen flows in the last couple of years, but we think that won't endure. We feel that that's a blip and that this will return because there's more scrutiny on asset owners and asset managers to consider sustainability. So overall, we see sustainability as helping to improve our understanding about quality and manage risks within the portfolio as we're investing for the long term. So what does this mean in practice? So the trust has got a differentiated sector positioning. So the trust is underweight energy, metals and mining, defence, tobacco, and is overweight some of the sectors like financials, technology, industrial. So there is a differentiated sector exposure there. If we look at the carbon footprint of the portfolio, which is this chart at the bottom, versus UK income investment trusts with a yield ahead of the market, you can see that it's got a lower carbon footprint, and versus the benchmark FTSE All-Share, it's about 45% lower. But so that's sort of like, sort of a one lens to look at it. Another thing that's really important for us is engaging with companies. So we're continuously speaking to the holdings about ESG as part of our fundamental analysis on companies. We spoke to the majority of the portfolio last year on ESG topics. And I'll give you an example. We've been speaking to National Grid about their community relations work, because as they expand and roll out the grid in densely populated areas of the UK, community relations are becoming vital for them to be able to deliver those projects on time. So that would be the type of engagement that we'll be doing with companies. And we find it really helpful to be able to speak to different people within organisations as well, in order to get a more holistic view of that business. So final one for me, just on the valuation. I think the chart on the left-hand side is probably a chart which many of your viewers have seen before. It's showing the valuation of the UK market versus other markets, which is currently below historic median and it's towards the low end of that historic range. And this is in sharp contrast to, say, the US and other markets as well. So even though, as you say, sort of the market's had a good year performance, so it's up double digit, the UK market's still on less than 12 times PE, which we think is an attractive valuation for the market. But we'd go further. We'd say that actually there's a triple discount here. So you've got the market, you've also got the valuation of the portfolio. So historically, Dunedin has had a premium valuation to the market, which reflects the higher returns that you're generating from the companies and also the growth outlook of those companies. So the return on equity of the portfolio is about 21% for Digit. And that compares to about 15% of the benchmark. So you're getting a higher return, so you'd expect it to have a premium multiple. But that premium has really compressed. It's gone from about 30% to 20%. So I think that's another sort of reason for a valuation argument for the trust. And then finally, it's the NAV. The company was trading in line with NAV, say, a year ago, and it's now trading at a 12% discount. So if you take that, that's sort of a triple discount, a discount on a discount on a discount. And we think this creates a compelling opportunity for investors to get exposure to what is a differentiated portfolio, but at an attractive valuation.
Thanks very much, Rebecca. And I think that's just a really important thing to talk about, that the valuation being very attractive at the company level, at the portfolio level, at the trust level, and then to talk a little bit about why going forward from here, aside from valuation, that we think this is a good time to consider Dunedin. I think the first thing is that we do feel we're moving into a more favourable backdrop. There have been a number of headwinds for Dunedin over the last couple of years. We faced rising real yields, and you can see that on this chart from the beginning of 2022, a significant increase, nearly 400 basis point increase in US real yields. That tends to be the discount rate off which equities are valued. And typically, as Rebecca said, we have a portfolio that invests in the more expensive parts of the market to get the resilience, to get that long-term growth. That's been a material headwind for us through 2022 in particular. As you can see, though, while it may bounce around, we feel that most of that is done. We're not going to see a 400 basis point headwind. It might go up 50 basis points, it might go down 50 basis points, but it's now more or less in line with the long-term real yields that you've seen going back to the 90s, since the Second World War. So that we feel is something that's more of a score-draw type environment for us. The next thing that we think is important is that the UK economy is recovering. We've come out of recession, we've come out of a period of uncertainty. You may like the budget, you may not like the budget, but I think as far as we're concerned, we're now in a position out over the next 4 to 5 years where we have a much clearer picture as to the environment that we're operating in. And we think that should be helpful both for the companies within the portfolio, but also to attract capital flows into the UK and particularly back into UK equities. Though, we're operating in an environment where geopolitical risks remain, whether it's the Ukraine, whether it's the Middle East, whether it's trade tensions, whether it's US elections, whether it's conflict in China, or a number of other elements that are out there. And so we think that focus on resilience, on investing in companies that can both do well in cyclical upturns, but also in tough times, and that aren't dependent on too many extraneous factors, we think is really important as well. So again, that underpin, that focus on quality. And so we certainly see the environment moving much more back to being more balanced for Dunedin. It might not be huge hurricane tailwinds, but we're certainly not facing some of the headwinds which we faced particularly in parts of 21 and 22. And with that, we think we're very well positioned both for that return to total return, for capital growth, income growth, and to be able to continue to deliver the dividend to our investors.
Okay, thanks, Ben. Thank you, Rebecca. That was very interesting. I'm going to ask the managers a few questions, but then it's over to you, as I said before. So do send your questions in. I think there's lots to engage with here. But Rebecca, starting with you, as you highlight, the Trust has a very different composition from the FTSE All-Share. Could you explain the investment restrictions that you and Ben operate?
Yes, so as mentioned, we're able to invest in UK companies, and also we look at European companies as well. So if we think about that opportunity set, it actually is about 1,000 companies that we can invest in. But we do have a sustainable investing approach, which does look to reduce the portfolio's exposure to certain business practices and operations and companies which we feel have got the highest ESG risks. So we think that reduces that opportunity set by about 25%. There are certain sectors which the Trust will not invest in, including tobacco, weapons, coal, companies that fail the UN Global Compact, and then companies through our analysis are not managing their key ESG risks. So I think it's about 25% of that universe, which is screened out by those negative exclusions. But what I'd say is more important when it comes to actually building that concentrated portfolio is looking for those companies which have got sufficient quality characteristics, the financial strength. They're in industries which are attractive. They've got strong competitive positions. That very much is more restrictive when we're thinking about companies that we can invest in. And then on top of that, where are the most compelling investment ideas? So here we're leveraging the research from our sector analysts and our teams to be able to identify which of those ideas that we think are able to deliver not only that resilient income, but the opportunity to appreciate from capital perspective too.
Okay, and moving on to the sort of your allocation within the UK, you said you're overweight in mid-cap stocks, and as you said, that's an area that's been unloved for a while. Are you confident of a re-rating in mid-caps?
Yes, so about 30% of the Trust is in the UK mid-cap and small-cap index, and that is double that of the benchmark. So we are taking a strategic overweight position. It has been unloved. There have been outflows out of UK equities, which means that the valuation of that UK mid-cap index is looking attractive for the underlying growth and resiliency that you're getting from those names. And there have been lots of headwinds to the index, and we do think that most of those headwinds are now out the way. So we have had a change in government. We've had we've had peak interest rates now. We're now starting to see interest rates come down. The budget's now out the way. So these were lots of excuses and reasons not to look at the UK index, and we feel that many of those overhangs have gone, which should mean that investors can come back and look at the UK index, and particularly those UK domestics, which we have a number. We've talked about Softcat already. We've got Morgan Sindall. We've got Genuit. So we've got a number of companies in that space that we think offer a really compelling potential for future returns. Okay, and that is it does make you stand out a little bit from some of the competition. You're also using, sticking with the UK though, Ben, I was going to ask you about one of the chart that you were showing, how the bulk of returns come from dividend growth over the years. It also suggests there's sort of very little multiple expansion, so the kind of multiple applied to the earnings, the profits, it's been pretty static over that time. Is that right?
It is when you look at the data, Gavin. I think it's interesting though, because again, I think it tells you about what are the kind of investment cases that we should be looking for. And yes, sometimes we'll be looking for re-ratings, but actually most of the time the return doesn't come from re-rating. It comes actually from the price that you pay,
genuine growth
in earnings over the longer term. And it's that focus on both the resilience of what you're paying for today and the ability of companies to be able to deliver in the future that's really, really key. And I think that's something which is again sort of built into the way we think about the companies when we're looking to potentially invest in them. It's fairly rare that we buy something because it's on a 10 times earnings and we think it should be on 15. The way we would normally think about it is it's on 10 times earnings, we're getting a 10% return, and we think the stock can deliver 5, 10, 15% earnings growth per annum, and that's giving us an attractive total return.
Okay, thank you. Rebecca, as you mentioned, you use options writing to boost income by about 10%. Ben, is that partly to offset the absence of some of the traditional income stocks you're excluding?
Yeah, it's something which we've done for a long time within the trust. So I think that predates our tenure on the trust. It goes back to, I think, the time of the financial crisis. We've been doing this. We write calls and puts covered. So calls over stocks we own, puts covered by cash. And I would say it's a pretty low risk way of generating additional income. And importantly, it's income that's generated that is uncorrelated from the rest of the portfolio. So our ability to be able to generate that option income in any one year has nothing really to do with markets going up or going down. It's really about the amount of options which we're able to write. It does depend on fundamentals. So we will only write a call, which is where we agree to sell something, if we are happy to sell part of that stock. We will only write a put over a company where we're happy to buy the company at that time. But it's generally taking a view, would we be better off buying today? Or might, if we don't think there's any great appreciation likely in the share price, maybe we're better off to write a put. It could be that we think at a given price, we'd be very happy to buy the stock, but it's not quite there. So it's almost like sort of waiting for the opportunity to come along. Equally, it could be with a company where we think the yield isn't particularly high. It could be a helpful way for us to buy some stock and then also write a put that can also generate some additional income. In terms of the risks, and I know Warren Buffett talks about derivatives as a weapon of mass destruction. Actually, most of the time, the biggest single risk that we really face is opportunity cost. That instead of writing the put, we should have bought the stock. I mean, that does happen sometimes. But if we look back over, since we've been doing this, the trust almost every year has generated more premium income than it's seen in stocks being called away. So I think just to give investors in the trust some confidence in the underlying value of that. And it's pretty helpful. I mean, it gives us that sort of 10% differentiation from income that can allow us to own some lower yielding, faster growing companies. And that we think is really important.
Okay, thank you. Sounds like you're managing the risks there. But turning to the holdings, National Grid is the top position after I think you added it last year. But it's had a busy time raising money from shareholders and also cutting the dividend. So what's the investment story there?
Yeah, so I mean, National Grid is, if you think about it, it's UK business, but it's actually 50-50 UK and US. So the US business, it gets good returns, regulatory returns on its assets, and it also does gas distribution. And then in the UK, it's looking at electricity transmission and distribution. The company is in a very different position now than it's been in the last couple of years. There is this, growing awareness and understanding that we need to be investing in electricity to upgrade the grid, to connect renewable energies, and ultimately to get the electricity from where it's being generated, which is up in Scotland, to where it's being consumed, which is down here in the south. And in order to do that, the country needs to invest. So the company did a proactive rights issue that addressed the balance sheet. It now means that we've got very good visibility for asset growth for the business. So the company believes it can deliver double-digit asset growth out to over the next couple of years to 2029. And then on top of that, that translates into good earnings growth as well. So about sort of 7-8% earnings growth year on year. And the company had good results this morning as well. So that's very sort of different position that the company is in than it's been in the past in terms of that visibility of growth. And then meanwhile, you're getting about a 5% dividend yield that's linked to inflation. So it's giving you that inflation protection in the portfolio. So a lot of things to like from an investment idea.
It's probably just worth adding, Gavin, to that we really took advantage of the rights issue, because you may remember the stock fell pretty sharply on the back of that. And some of us are old enough to remember the last time that they did a rights issue, I think back in 2010, where it had a very similar reaction, which proved to be a great opportunity. So I think within the portfolio at the time, it was 2.5-3% of the assets, and we've taken that up to 4.5, and then it's gone on to do quite well. So we look at that and think if you can effectively get government guaranteed 5% inflation plus, that's going to give you a double-digit total return. That seems pretty good. In fact, maybe we should just put the whole portfolio in it. Yeah,
we've got it at low, and you've got conviction. That sounds good. We also hold Unilever, which has also been having a sort of difficult time. What impact is the new chief executive, Hein Schumacher, having?
Yeah, so that's about 6% of the trust is in Unilever. And again, this was an example of taking an opportunity to buy into a company when it was highly discounted. So about 2 years ago, the market was very negative on the company, sort of poor underlying organic growth. The margins were under pressure. There was sort of lack of confidence in the management team, and the shares did fall sharply on the back of that. And that was when the trust took a material sort of increase in its position holding now. So as I say, it's now 6%. So we've got Hein Schumacher's come in. He has set out a growth plan, which is about sort of doing fewer things but doing them well. Really focusing resources, focusing on their power brands, brands like Vaseline, Dove, Cif, Horlicks, Hellmann's, and then getting good growth there from those brands. And we've seen, the company has reported last month that volume growth is now picking up. It's broad-based across all the divisions, and those power brands are growing volumes about over 4%. So I think we're starting to see early signs that this strategy of focus, of resources and innovation in those power brands is starting to come through in terms of the volume growth there. And then in addition, we've got sort of additional self-help around, the gross margin recovery, looking to improve the efficiency and some cost cutting within the business, spinning out ice cream, for example, sort of separating that. And so there are a number of self-help initiatives which are in place, which you've got a strong company with powerful brands, exposed to emerging markets, high exposure to India. That presents attractive growth opportunity for the company, plus self-help. And the yield is at over 3% now, but sort of a good outlook for growth for that yield as well. So I think the market has started to wake up a bit to the Unilever story, but we still like it, and it still remains a core holding.
Okay, and you've got 20% in non-UK stocks, so I'm going to ask you about a couple of those. Why Volvo?
Yeah, it's interesting. So it's the truck company, not the car company. So Volvo is a really interesting company. If you think about trucks, the first thing that might come to your mind is that sounds very cyclical. That sounds like a very capital-intensive business. That sounds like all the things which you've talked about not investing in. So why do you own Volvo? If you go back to 2009 and the financial crisis, I think it was Q1 results 2009, Volvo registered orders of one truck. So typically it might be 50,000 in a year. So it's a cyclical industry. From that point, though, the company, through a series of changes under management, has really worked hard to create a very flexible balance sheet, a very flexible operating model, has significantly increased its margins, created a focus on the areas where they can actually have sustainable growth. And the industry has become much more consolidated. So you're really talking about 4 or 5 key players. So it's a much more rational industry, a much better run company. The business today is delivering good double-digit yields, getting up into the 15s perhaps in good times, margins. And it pays out all of its excess cash in dividends, and it has a very, very strong big cash pile on the balance sheet. So it pays an ordinary dividend and tops it up with a special every year. And it's a business that fundamentally is exposed to some good levels of structural growth. So the ability for logistics to grow as an area is pretty good. It's not sort of Tesla, but it's GDP plus. So they're effectively supporting that. And they have a really good technology position as well. So it doesn't face the disruption from low-cost Chinese competition, perhaps that some areas that the automotive industry does, much more consolidated, and they've got a leadership on the technology evolution. And fundamentally, it's dealing with corporate customers, and they want a really efficient, great value product. And so it's been a really interesting story for Volvo over the longer term, evolving from a pretty sort of, I would say, kind of really sort of deep and dark cyclical stock to something which has actually become, I think, still a cyclical business, but a very well-run cyclical industrial that pays a very attractive dividend.
Okay. And you don't hold a lot in energy companies, but you hold Total.
Yeah, so I think it's a really good example, Gavin, of us. We have a pragmatic approach to thinking about sustainability. We have some criteria, which Rebecca talked about earlier. We can't invest in companies that have got shale. We can't invest in companies that have got really polluting areas. We need companies to have more than 50% of their revenues coming from gas, electricity, and renewables in the upstream, and Total has that. And I think importantly, Total is a company which has had a consistent approach to how it's managing its business over the last decade, certainly since Patrick Poyan came in to be the CEO when the previous CEO died. I think it was back in 2012. The strategy of balancing oil, gas, renewables, what they're doing in downstream, what they're doing in terms of green energy has been very consistent. Any of our viewers, in terms of following what BP has done, seems to change every couple of weeks. What Shell's doing maybe that changes every 6 months. But what Total's been doing has been very consistent. And it's that focus on growing energy, but also growing that renewable and electricity part of the business. And they've done a really, really good job on that. And I think important, go back to 2020, Total didn't cut its dividend. And both of the other UK majors did. And I think it's that combination, very efficiently run company, good long-term strategic view, and consistently looking to return cash to shareholders in a sensible way that we really like.
Brilliant. Thanks, Ben. Okay, got a few questions from the viewers now. So first one is, do Ben and Rebecca do their own investment research and company engagement for the trust, or is it undertaken by support teams?
Yeah, we do our own research. I mean, we work as a wider team. So we have a team of analysts which are sector focused, and they focus more on sort of the big caps, the large caps. They're looking globally at the best ideas within their sector focus. So they're sort of bringing that sector specialism, and we can use them. So, whether it's sort of the pharmaceutical analyst or the financials analyst, it's really helpful for that analyst to be able to look across the market, to be able to identify ideas within that wider context. But for names that aren't covered by that sector team, then we'll cover them ourselves if we want to own them. So yeah, I cover about sort of 15 to 20 companies, mostly UK mid caps, which aren't covered by that sector team, but are ideas for the strategy or for other strategies that I run as well. So yeah, lots of sort of meeting companies. That's very important to the investment process. We like to meet our companies about twice a year. In addition, we may have some ESG meetings as well, which would be run by either the analyst or the fund manager, in addition to the ESG analyst. So trying to get sort of multiple points of contact with that company. And I think what's great about the culture and the setup at Aberdeen is that we can then debate those ideas. So we have a weekly research meeting with the analysts and the fund managers to debate and peer review that research. And so, really do sort of kick the tires on an investment case ahead of buying for the portfolio. So I think we've got our own coverage, we're able to leverage that resource, but ultimately it's our responsibility about what goes into the trust.
Of course. Ben, we've got another viewer's asking about performance and saying over 5 years. This is a fair comment. Over 5 years, it looks like most of Dunedin's return is coming from the dividend. Is that correct?
It probably is. Certainly, when we look back over the 8 years, I think about 35% of the return has come from the dividend. I think that partly reflects that we've sort of tipped a little bit into a slightly tougher period for relative performance. And so if you go back to January 2024, where we closed out the year, Digit outperformed in the year by about 4%. And I think we were the best performing apart from Lord Venture Trust over 5 years. So that was pretty good. You move forward 8 months, you take 8 good months off the back end. We've had a fairly tricky start to this year for a number of reasons. And suddenly that doesn't look quite so good. And that's sort of what's been lost has probably been that capital growth piece, and the dividend bit has been sort of left behind. So it looks like the return's coming from there. But over that longer term, it's probably 65-35. And what we really want to do, Gavin, is to make it more like 50-50, something like that. So you've kind of got that good underpin from the dividend, and then you've got that higher level of return coming from growth. And I think if we we go back over time, over history, going back a longer term, almost all the return was coming from dividend, and gradually there's more that's been coming through from the growth side as we reposition things.
So the growth should be coming back
I think so,
in the future. Good. So let's turn to events yesterday. The result of the US election. Trump's return to the White House has seen a couple of economists at investment banks lower their forecast for UK growth. So after an encouraging year for the UK stock market, limited encouragement, investors still seem to be pulling out. What are your thoughts on what the impact might be of a second Trump administration?
Wow, it's quite a lot. There's quite a lot to think about, isn't there?
Tariffs, I suppose, and the effect on
I think one of the
UK and European companies. In fact.
Yeah, I think one of the important things to remember is that 70% plus, maybe 80%, I think 75% of the revenues in the FTSE come from outside of the UK. So the UK is important in terms of what happens to the UK economy. And it's particularly important for the mid-cap space, where it's probably more like 50-50. But the global economy is also really important for the UK stock market. And as I showed you those, the top 8 dividend payers, they have very little business in the UK, and they're driven by a lot of these big macro elements, interest rates, oil, mining, perhaps what's going on in China and the US, quite relevant for these businesses. So I think it's always important to bear that in mind. I think from a Trump perspective, I would just say I don't think anybody really knows. I don't suspect that Donald Trump doesn't know what he's going to do. And I do find it kind of amusing when I look at all the detailed policy analysis that comes out, because I'm pretty sure that's not how he thinks about the world, right? Donald's priorities are going to be his legal cases, himself, and his family. Those are probably going to be the first 3 most important things he's going to think about. And that's pretty much how he thought about things in the past. And probably the 4th thing will be making America important. And I think that's the lens that you've got to think about how and what he'll do. And he's very transactional, as everybody knows. So exactly how that's all going to play out, I think, is pretty uncertain. I think, yes, there'll probably be less regulation in the US. Yes, there'll be less taxation. But I think everything else is really up for negotiation. And so I think it's going to be kind of interesting. I mean, I was asked yesterday, what were we doing? And I said we were having a cup of coffee yesterday. So, I think you just got to wait and see how this stuff's going to evolve, because I think sort of trying to jig around in anticipation of something that may or may not happen, I'm not sure that's necessarily the right way to go about it.
Yeah, don't rush to conclusions. What about the budget? Any thoughts on the budget that's happened recently? Obviously, I was just wondering, Rebecca, you were alluding to the triple discount on this 12% discount that your shares, the Dunedin shares are trading at, and did any of that result, reflect some selling before the budget in relation to the anticipated capital gains tax rise? Just because, as you've been alluding, the long history of the trust means there must be people with a lot of capital gains in there.
Yeah, so maybe just a point on the discount that wasn't covered in the presentation. The rise in interest rates has been unhelpful for the whole sector in terms of expanding the discount for the sector. But there have been some company-specific drivers of that wider discount for Dunedin. So there's been a transfer of some of the shareholdership from an Aberdeen platform to Interactive Investor, and this led to some additional selling pressure on the shares, which has certainly been unhelpful in this market. The board's been proactive in terms of a buyback, which has been ongoing and sort of quite substantial in terms of looking to buy back some of those shares, and that's ongoing. But we sort of continue to focus on performance, raising awareness of the trust as well, and hopefully look for that discount to close over time. And then maybe on the budget.
Yeah, last question. I was going to ask you about thoughts on the impact for UK businesses, offsetting tax rises versus investment.
I think it's helpful for us to have a high-level understanding about what the priorities are for this government in terms of taxes and spending too. And we did see the OBR upgrade the near-term GDP forecast for the UK on the back of the spending plans and the investment plans that the government set out. So that's helpful. It's already on the back of, as Ben mentioned, the UK economy is recovering, and we've seen some positive revisions in that GDP. So I do think that's supportive for those UK domestically focused companies in the portfolio. In terms of investor sentiment, I think it removes another overhang, and I think that we'd start to see a pickup and some initial optimism returning about the UK, which was translating into flows at the start of the summer. That then cooled down in anticipation of the budget, but now that's been removed. I'd sort of hope from here forward, actually, the valuation case is compelling, as we've outlined. There's some really great companies in the UK, and so that should get investors to come back to look at the market.
Yeah, Ben, anything to add to that?
Well, I think it was interesting. I think to that point. I'm not sure I would fully agree with the government's approach, but ultimately that's the approach that they've gone down. I think, as Rebecca said, the benefit of that is that it's happened, so we can kind of move forward. And I think what we would really like more than anything is that the stability in those decisions, so that they're not constantly changing. And I think that's probably one of the things that has been particularly frustrating. If you think about the constant changes to UK pension regulation, there's a cap, there isn't a cap, there's a savings limit, you can't manage your future over 30, 40, 50 years if that changes every couple of months. And I think it's much the same with the economy. So it was encouraging to hear Rachel Reeves saying, there aren't going to be more tax raises when we come to the next mini budget. And I think just being able to set out that framework, they clearly said they want to focus on the supply side. That involves a huge amount of work, enhancing productivity in the public sector, being able to drive the reforms on planning, being able to bring in the infrastructure investment. There's a lot to get on with in that, which isn't necessarily about the kind of fiscal side. And I think that's what the government should really focus its efforts on.
Okay, thank you. Well, I think that's all got time for. Let's leave it there for now. But yeah, thank you very much for joining us. I hope what you've heard has whetted your appetite for investing and has been and given you lots to think about in terms of sustainable investing in the UK market. But a final piece of housekeeping: please complete the feedback survey, as we're always keen to improve what we do. But in the meantime, thank you so much to Ben and Rebecca and to you for joining us today. Look out for more of our investment trust programmes. In the meantime, goodbye and happy investing.